Hello, everyone. Thank you for joining on a lovely Saturday morning. We will be starting sharp at 11:05, and we thank you for your patience for joining early.
Komal, I think people are joining in. We'll start in the next 2 minutes. So this is just for the information of people who have joined in. Just waiting for some more people to join in. So around 11:05, we'll start the meeting. Thank you.
Hello, everyone. We thank you for joining on a lovely Saturday morning. And today we have with us Mr. Balaji Vaidyanath, Director and CEO of NAFA Asset Managers, and Ganesh A, co-founder at FPS Assets. Mr. Balaji has a solid 2 decade two decades of experience and a solid record as being a fund manager. He was previously a fund manager at Sundaram AMC. Thank you for joining us today, sir. And we also have with us as moderator Mr. Ganesh, co-founder and head of products at FPS Assets. Over to you, sir.
Thank you, Kamal. Thank you, Balaji, for joining us. And thanks everyone for joining us on a Saturday morning, especially on a Valentine's Day morning, right? So for a lot of us, I think investing means a lot, and we take our investing very seriously. So in a way, this Valentine's Day we're celebrating with fellow investors. Right. So let's go on to the presentation. Just before we start off on the topic, right, on small caps, uh, the whole time to press the throttle, right? Before we get into that, I just want to give a quick background on what we do at FPS Assets and how we went about choosing NAF asset managers as our partners with the curation of this product, right? So as we always say, our belief system, right? There's always a bull market somewhere. So the last 1.5 years have been pretty much a little bit challenging for the world in different ways. But then we were able to find bull markets in different places, albeit not in the same places that we usually expect, and which usually is the case, right? You'll never expect to find a bull market in places that you expect. So we found it in metals and precious metals in the last 1.5 years, and it's been for the right reasons moving up and due to global turbulence and all that. But in today's context, where are small caps coming from? And how we need to approach small caps as a universe is what we'll be looking at in the entire presentation. Like I said, before we get into the specifics of small caps and the universe, and before passing on the podium to Mr. Balaji, I would like to go through some of our investment philosophy as well. For FPS assets, if you look at it, as you would all know, we're long-term investors, and our thinking is also aligned to that long-term thinking over a 3 to 4 years perspective, where we carry a very low risk approach, right? So usually the consensus in the market is that you need to take a high risk to get considerable returns. But usually what we keep saying to people is that you keep your margin of safety pretty high or pretty solid, and then you'll be in for making considerable returns over a period of 3 to 4 years, right? And we usually follow a very market neutral strategy, which means that we don't tend to see where the market goes in the next 90 days or 180 days, where our expectation is more bottom up in nature, and we're purely valuation focused, right? We don't believe in paying more than what any asset is worth its value, right? And towards the next slide, what we believe in is showing to you guys is the triple E power, right? What we as a team have with our ammunition is the triple E power, which is nothing but education, experience, and execution. With that, I'm very, very happy to introduce our team. So it's a pretty solid team that we have built since our launch in the last 6, 7 months, right? So people keep asking us, you've started just now, but then you've already built your system for more than 2,000 crores to manage over 2,000 crores. So that's what is our thinking from a very long-term perspective, is what we have managed. And if you look at our team also, if you look at the investment team, right, predominantly, we are a 7-member team, while this shows you that our research capabilities are very, very strong. And the reason why we are able to partner with the able people like NAFA is that we are able to identify them as stronger partners who would aid us in this journey of wealth creation for a lot of our clients and prospects. And just to give a brief on our existing client base, right? Who are our clients today? So we have promoters of listed entities being our clients. We have highly qualified professionals like doctors, CEOs, and teachers being our clients. We have certain advisors to the government of India being our clients, and NRIs who are building India's wealth being our clients. And the kicker in the back, or the icing on the cake, is that asset management and sell side industry players also are our clients today, which means that this, just to give you a sense of what kind of people we currently manage, or rather whose wealth that we manage today, because all these are able people, right? They have found success in their lives, in their careers, and they would have done their due diligence before zeroing in us as their wealth manager, right? So this is what we wanted to give you as a overall thinking, right? Of who are you going to be partnering up with, because our existing client base speaks for itself, where you have advisors to the government of India and promoter of listed entities being clients who would have done their basic or rather intense due diligence before zeroing in as their partners in their wealth creation journey. And the next question is why NAFA, right? So if you see NAFA, what we've been tracking NAFA and Mr. Balaji Vaidyanathan for a pretty long time. We've known each other as, as professionals. And we have always understood that they have a very strong leadership and professional competence that backs their claim and their long-term track record, right? And what is more important is that in any investment management business, right, it's important that you have a unmatched or a good amount of network across sectors to understand how industry operates. And because since if you're into investment management, you track different sectors, different industries, so you need to have a network across different sectors to get your market intelligence and accordingly act in the client's interest. And we've always found their approach to be of high conviction. And the icing on the cake in this case is that they have a very single-minded organizational approach to investment management, which means they're not sometimes what happens is your focus is split across different things that you're not able to provide a lot of energy to that investment management as a function. But in NAFA's case, what they do is what we essentially do in a different way as well. Their bread and butter is completely investment management, which is why we were able to find the sync with NAFA as an asset manager to give our clients the best out there. And just a brief about the investment manager, NAFA Asset Managers. It's an India-focused financial services firm. They have an experienced team of professionals handling this, and they've done this for more than 10 years right now. And if you look at the main man, Mr. Balaji, he has more than 20 years of experience in the industry, where he's worked with Sundaram and where he was a research analyst at Sundaram, and then he moved his way up the ranks, and then he started his own firm called NAFA as well, where he is currently the CEO and the CIO, where he takes the call on the investment management decisions overall. Right? That's it from our end, people. So now I pass the mic to Balaji to continue with the presentation. Thank you so much, Balaji, for agreeing to be part of this presentation. Over to you.
Thank you so much, Ganesh, for the kind introduction, and thanks to the FPS Assets team. And I thank all the people. Sorry. I thank all the people who have taken their time on a Saturday morning to be part of this webinar. So, we have seen a situation where, we saw a unidirectional market since 2020, second half COVID, when, global central banks across the world just pressed the stimulus button, and we saw a unidirectional move in the markets for almost a whole of 2020, calendar year 2021, 22, 23. And from September 2024, something actually changed. The equity prices, the equity markets stopped, its unidirectional move, and we saw a bit of correction in various segments from September till March. And March, again, there was a bit of a rebound. And from March, April 2025, again, we have seen a one-way drop in the markets. So over the last 18 months or so, we have seen a extremely tumultuous time in the markets, which is not particularly represented by the indices. So if you look at the index, be it the Nifty or BSE 500, etc., these seem to be somewhere close to its all-time high. But still, the portfolios of individuals are not really anywhere close to all-time high. So typically, the newspaper talks about Sensex or Nifty being 5% away from all-time high, and then people check their portfolio is probably down 15%, 20%. This kind of scenario has been prevalent for the last 18 months. So this is probably the first ever correction that has meaningfully happened over the last, I would say, 5 years or so, from being a very unidirectional market. So under this context, the team of FPS Assets and NAFA, we came together, and we sometime in the fag end of last year, maybe November or October, November, we kind of decided to go ahead with this fund called NAFA India Alpha Fund. Okay, so I'll explain about why this fund, why at this point in time, and what one can expect in terms of returns, not the actual number, but in terms of overall expectation setting, etc., as to why someone should opt for NAFA India Alpha Fund. So before that, some brief in terms of India. So there's not many macro slides over here. So generally, we say that the equity markets become more favorable when the ratio between the GSEC yield and earnings yield of the index is very low. So you can see that the long-term average is at a certain level, and currently the ratio of the GSEC yield to earnings yield is below the long-term average, which obviously means that there is a fair amount of valuation attractiveness as far as the market goes, depending on the segment that you are present in. So generally what happens, in a stock price, drivers of stock price, we're talking about price, we are talking about EPS, we are talking about price to earnings multiple. So price is equal to EPS into PE. So if you look at India as a stock, you have very strong fundamentals, which is basically your infra boom in terms of roads, railways, freights, ports, etc. And then there is a digital economy push. Therefore, we don't need to go through the fundamentals again as far as India is concerned. That is something that is very well known. Fourth largest economy in the world. In the pecking order of GDP, we are probably the number one now. And the so-called financialization of assets, which one has been expecting for a very long time from 90s till date. Finally, that is happening because traditionally, Indians went for physical assets, which includes real estate and gold. And now, the younger generation is moving more towards financialization and looking at mutual funds, equities, AIFs, etc. So even the physical assets are now being bought in the financialized form, which is, your ETFs and index funds. And even for precious metals, we saw that there was a huge interest in the ETFs of the precious metals, basically. So financialization is here to stay. And for the first time, we are seeing a situation where the DII ownership is set to surpass the foreign investors. So for a very long period of time, although we attained independence in 1947, but if you look at the Indian stock market, the foreigners were actually holding more stock than the Indians. The foreign institutional investor holdings were higher than the domestic institutional investor holdings. And for the first time, the DII ownership has actually surpassed the foreign investors ownership, meaning that more Indians are indirectly owning Indian equities compared to what it was, about a decade or 2 decades back. So obviously, when you have such great fundamentals, demography playing in your favor, and there's a fair bit of stability as far as political governance is concerned. So you're having low currency risk and a low country risk. So 20 years ago, you had as Sensex, which was probably trading at a 16 PE multiple, and then slowly it got re-rated. The multiple expanded from 16 to 20 10 years ago, that is 2016. Today we have a situation where the Sensex is currently at 23 PE multiple. And BSE mid cap was at 14 and today it's at 30. BSE small cap was at 10, today it's at 30, right? So the thing that many people ask is that PE multiples have moved up, therefore there is all the juice that has been that has to be obtained has already been obtained. There's no further scope for upside. This is a very theoretical way of putting it, but if you actually look at it, if you take the great bear market of Nikkei, Japan, for 20 years, there was absolutely no movement in the Japanese stock market. The PE was always low. That doesn't mean that it found any kind of investor interest and attraction as far as the stock market is concerned, but it continued to underperform the global markets. It never gave any returns for the last 20 years or so. So even in India, you can point to individual stocks where the PE was always very subdued, but still on a 20-year basis, they barely just have not made any money. So for example, Wipro, never kind of gave any meaningful return for the last 15-20 years, despite being at a reasonably valued stage. So one thing is to look at the index level PE and to make a decision in terms of asset allocation. Other thing is to dwell deep into the constituents of the index. Why is it trading at these levels? And whether it makes sense to do asset allocation purely based on this number is something that we need to look at. So in terms of the Asia's market landscape, right? So if you look at the BSE mid cap and the BSE small cap, so this is the recent data that we are talking about. Despite the so-called correction that has happened in the markets, over the last 18 months or so, where the median fall was in a stock was almost 20% plus. You have seen a situation where the BSE mid cap and the BSE small cap index has probably done better than any Asian index, Australia, Indonesia, Taiwan, Hang Seng, Shanghai. So on a 3-year basis, 5-year basis, 10-year basis, after the correction also, of course, 1 year there can be extreme amount of noise, but beyond that, we have kind of done well. Goes to show that there is a real there's something, this entire premise of premiumization, moving from unformalized economy to a formal economy, non-GST compliance to GST compliance. Also the fact that people are promoter driven firms are formalizing, professionalizing. uh, so all these things are getting reflected. So all the series of reforms that have happened over the 10 years, 15 years. So the fruits of that we are seeing, and we will continue to see for the decades to come. So we've had an extreme amount of rally in precious metals. That is something that we all very well know, that gold and silver has been on a roll over the last 2 years plus, especially silver. My in my 21 years of experience, my single thumb rule is that when a financial news becomes part of mainstream news, something that just gets covered in the financial newspaper, if it becomes headline in a non-financial regular newspaper, that is either the peak or the bottom of that particular segment. So when it becomes a dinner table conversation, or when you generally socialize and people only have to talk about the way precious metals have rallied, people talk about gold and silver, and these are all telltale signs that things have generally, you should be very very cautious allocating incremental capital into the said asset. So I'll just give you an example. The largest traded stock in India by value is HDFC Bank. So on a typical day, HDFC Bank would trade anywhere between 2,000 to 3,000 crores in a day. And then you'll have Reliance, Bharti Airtel, and some other mid-cap stock that would have gotten listed, and so on and so forth. But generally, the largest traded stock is HDFC Bank, that trades around 2,500 crores. Over the last 1 year, especially during January, the silver ETF traded about 13,000 crores in a day. So the silver ETF traded at 6 times the largest Indian stock. So this is not industry demand. This is not, people are suddenly wanting more silver for industrial production. No, industrial demand has always been there for silver. That can rise, that can fall. That's a different thing altogether. But when silver ETF trades at 6 times the largest listed equity stock, that is clearly speculation, not inherent demand. And that is what we saw in silver when silver touched 400 rupees per kilo. I don't know what it is now. I think it's around 260 rupees per kilo, if I'm not mistaken. So from there on, it saw a very, very sharp fall. And, we have seen some amount of stable trading over the last 5, 6, 7 trading sessions on the precious metals side. So this is something that I wanted to tell you, that I found this start very interesting, that the kind of madness that can happen. You can see it via the trading volumes. This is like where people rush to get into that bus, that train, desperately. So that's a classic case of a speculative thing that is happening in a particular asset class. So will he, won't he? This is all very reminiscent of 2018 to me. We saw the tariff 1.0 version of Mr. Donald Trump. When during his first term, he actually kind of put tariffs on steel, Chinese steel, in 2018. And that was the first time in a globalized world we got people had forgotten about tariffs till then. We got the feel of tariffs in Mr. Trump's first term. which then when Biden actually came to power, he never really revoked the tariffs. Those tariffs still continued. Although a Democrat came into power at that point in time, the tariffs on Chinese steel, which were imposed by Mr. Donald Trump, continued even during Biden's term. And now, when Trump took over last year, we have seen crazy rates of tariffs being issued to various countries. So you have seen that now there has been some amount of stability. Maybe he is also former. He's also a human being. He saw that we were, cutting deals with the European Union and New Zealand and many other economies. And he's now removed the punitive tariff of 25%, and he's reduced the reciprocal tariff from 25 to 18%. So this has now put us either on par or even lesser than some of the other Asian counterparts like Vietnam, Bangladesh, China, etc. So it gives us, so this major monkey is off the shoulders, at least for now. With Mr. Trump, you never know, because South Korea also, he struck a deal, and then he said that South Koreans are taking a lot of time to ratify their thing in the parliament, and therefore I'm increasing the tariff. So this tamasha might continue. We have no control over it, but as of now, we have a base case scenario of 18%. So this is what we need to work with at this point in time. And this is expected to boost India's growth. So this entire tariff impact resulted, I would say, one of the many reasons why we saw, the narrative was tariff, and there was a segment, and there was a high valuation. We saw 18 months of time and price correction in the markets, which was quite brutal, especially in the mid and small cap side. But in these 18 months, if you actually look at the countries that have actually done well in these 18 months, it paints a very, very funny picture to me. So you have a Karachi Stock Exchange, which has done 70, 80% on a 1 year basis. You have Bulgaria, which has done about 40, 50%. You have Greece, which has done about 40, 50%. You have DAX Germany, which has done around 30%. So the question that needs to be asked is, the rally that has happened in these countries, are these sustainable? Why would a country rally? The demography is in favor. There's a young population. There is a able workforce that is available, etc. So when you're talking about countries like Europe, Eastern European economies, etc., the fundamentals are very simple. A shrinking workforce, aging population, the fertility rates have plummeted to less than replacement level. So, for example, in Germany, I think the fertility rate is less than 1. For replacement level, you need 2.1 fertility. Just because that there is a NATO narrative that they have to, increase more on defense, the tax has rallied. See, Germany can build an aircraft, but who's going to fly the aircraft? Do you have able-bodied pilots who can fly that aircraft? Do you have a 25-year-old who can do a sortie? These are all questions that people need to ask. So are these rallies sustainable? I don't particularly think so. These have been countries that have been underperforming for a very long period of time. So there was a bit of a catch-up rally in these countries over the last 15, 18 months. So once that catch-up rally is done, you would probably, the capital allocators would once again start looking at countries which are growing very fast, in terms of the pecking order of GDP growth, in terms of availability of labor, in terms of reform measures, in terms of growth in per capita. So in that, whether you like it or not, India would see itself in a very strong position, and therefore a lion's share of FII flows could once again return to India. The timing is something that we can't predict. It can be next month. In fact, over the last 3, 4 trading sessions, we did see FIS pumping in some amount of money in the Indian markets. Of course, yesterday again there was a bit of a reversal, but these things are, over a long period of time, you could see that we could receive lion's share of flows. But the bottom line over here is that we don't know whether the FI is going to come and buy my stock, or the DI is going to buy my stock, or a HNI is going to buy my stock. The very, very simple thing, logic and understanding is, if something is worth 100 rupees, and if I'm paying 65 to 60 rupees to buy that particular thing, that is going to get repriced. Whether that repricing happens via an FI buying it, or a DI buying it, or a HNI buying it, or a company buying it, we don't know. That time can only tell. But as long as you respect fundamentals, and how do I make money in the markets? I have to, if this phone is worth 100 rupees, I can't pay 150 rupees for this phone. I have to, if I have to profit on this phone, I have to pay only 50, 60 rupees to buy this phone. Only then I'll find a buyer at 90, 100, etc. In a highly liquid environment, if something is worth 100, you can buy it for 150 and you can flip it for 180 or 190 in a very short period of time. That is possible, but that is not a very sustainable strategy. So here you need to be extremely cognizant about valuations and uh, what you are actually buying. So that's where NAFA India Alpha Fund comes into the picture, right? So we look at small caps. I won't even say small caps. I'll explain small caps. Uh, Generally, what happens is that we have seen a huge fall in small caps uh, to the extent where the BSE small cap index is negative, right? So, for example, in this slide, you can see that on a 1 year basis, the BSE small cap index is minus 3.4% on a 1 year basis. So, historically, what we have seen is that on a rolling 1 year basis, whenever the BSE small cap index goes negative, like how it has gone negative at this point in time, the next 3 year return potential, there is a 95% probability that it will be positive. Okay, first thing is capital preservation. Second thing is growth of that capital. So when the rolling 1 year return of BSE small cap index is negative, and if you invest your money in this particular segment now, in the next 3 years, there is a 95% probability that you won't lose money. Point number one. Point number two, there is a for 46 plus 46 plus 19 plus 15, there is a 70% probability that your return is anywhere between 10 to greater than 30% CAGR. So joint probability 0.9 into 0.7, there is a 63% probability that if you invest your money in the BSE small cap segment today, on a 3 year CAGR, your returns could be anywhere between 10% bare minimum to greater than 30% also. So, so the point I'm trying to make is we are now, if you decide to put your money in this particular segment, there is a lot of disinterest. People have lost a lot of money. The neighbor has become rich by buying into gold and silver. Therefore, there's a bit of frustration. So people are exiting these kind of segments, these kind of stocks. They're not paying attention to the valuations, the EPS, what is fundamentally changing. Mind you, there has not been a major change in fundamentals. The change has only happened on the price side. So fundamentals, there can be a impact this way, that way. You can have 2, 3 bad quarters, you can have 2, 3 good quarters. So this is something that we need to keep in mind when we are allocating the capital. So where is NIAF actually positioned? NAFA India Alpha Fund. NAFA India Alpha Fund is where the regulator tells us what is mid cap, what is large cap, what is small cap. The regulator says that the top 100 stocks in India are large caps. So the 100th stock in India today is GMR Airports, which has a market cap of 1 lakh crores. 100 to 250th stock is mid cap. Uh, uh, so the 250th stock is NBCC. That has a market cap of around 30,000 crores. The 250th to 500th stock is what the regulator says as small caps. So the 500th stock today is Edelweiss with a market cap of 10,000 crores. But where do we operate in NIAF? Our median market cap is 7,000 crores, meaning we are even lesser than small caps. So just because a regulator says that this is mid cap, this is small cap, this is large cap, no, our segment is the greater than 500 stocks and below. So that is, we are having a median market cap of 7,000 crores. But just because I am having stocks in less than 7,000 crores, these must be risky stocks. These must be extremely kachara stocks. No. I can have leaders in their respective segments. I can have a company which is Asia's second largest or the first largest in its installed capacity, state of the art, manufacturing plant, etc., and it can still have a market cap of 3,000 crores. So that doesn't mean anything. So you are only present in that microcap segment where there is a huge potential from the point of view of discovery. So this can be under discovered or semi discovered stocks that can actually move up the cap curve. So when it moves to a 10,000 crore, it automatically becomes eligible for the small cap universe of mutual funds to look into that particular company. And if it moves to a 30,000 crore bucket, it automatically becomes eligible for the entire mid cap category of mutual funds to look into that particular segment. So as these stocks keep getting re-rated, it becomes eligible for more and more mutual funds to participate in this particular segment. So this is what I was mentioning in the earlier part of the webinar, that average portfolio is down about 24% from 52-week highs. So stock drawdowns are not equal to index drawdowns. Many quality stocks have also corrected. When there is an AI threat or whatever it is, that doesn't necessarily mean that only the respective stocks correct. Generally, when the sentiment is bad, every stock corrects. So typical anatomy of a stock that we hold in NIAF is 60 to 65% of the company is held by the promoters. Another 5 to 10% is held by the family and friends of the promoters. The balance is what is available as public float. So we are dealing with companies where the public float is effectively 15 to 20%. So therefore, the moves are exaggerated on both sides. So today, if I have to buy, I can have an exaggerated move on the upside. If someone has to sell, they can have an exaggerated move on the downside as well. This gives us an opportunity both ways, actually. So this kind of divergence actually gives an attractive entry point. So for example, we have a situation like when I mentioned earlier that the small cap price to earnings multiple is almost 30 times. I'm not going into even the forward earnings multiple. Even if we have to stick to the current multiple FY26, we have almost finished 80% of FY26. Just one more quarter is remaining. So it's almost the actual numbers we are talking about here. The price to earnings multiple of NIAF, Nafa India Alpha Fund, is 15 times. The price to book is around 2.7 times, and EPS growth is around 15%. Mind you, these are very conservative estimates. So we don't really kind of paint blue sky scenarios all the time. So we look at very conservative estimates. EPS growth of 15% is essentially, these are all companies that are growing at 2x the nominal GDP growth. Meaning that you have a nominal, I won't say 2x, but 1.5 times the nominal GDP growth. So nominal GDP growth is around, say, 9% or 10%. Companies are growing at 15% means that it's around 1.5 times the nominal GDP growth. If you want just a GDP growth, it's very simple for you to invest in a low-cost Nifty 50 index fund, which will mimic the nominal GDP growth. So your Nifty 50 returns from 1990s till date has been equal to the nominal GDP growth. But if you are looking to meaningfully beat the nominal GDP or meaningfully beat the Nifty, you have to be present outside the Nifty, and that's where NIAF comes in. And we are present in segments with 7,000 crores of median market cap, but growing faster, around 1.5 to 2x the nominal GDP. Therefore, the returns also could mimic that particular range, in our humble opinion. So, well begun is half done. That's the saying which people have said that. We started this portfolio sometime in October, November, and on a 1 month basis, of course, we are down. We will be down. We are down about 3.6%. But when you compare it with BSE small cap index, it's probably down 6.5%. On a 2 month basis, we are down 3.7. BSE small cap index is down -7%. And since inception, we are down -4%. BSE small cap is down -9%. So mind you, you can compare these data with the next column, which is BSE 500. Now, BSE 500 has an extremely heavy skew towards large caps. The HDFCs and Reliance and TCS and Infosys and the Bajaj and all these Mahindra, all these large caps of the world form part of the BSE 500 index. And generally, large caps, when they fall lesser than small caps, and small caps generally fall lesser than micro caps. But if you look at our portfolio so far, although we are running a micro cap strategy with just around 7,000 crores of M cap, median market cap, we are falling like a large cap. So essentially, the way I would like to see this particular product and position it is basically uh, large cap like volatility with small cap like returns. That is our endeavor. Will I fall? Definitely I'll fall. But will I fall less than small cap and maybe mimic the large cap? The answer is that's our endeavor. And when I go up, will I capture the upside like how a small cap captures the upside? That is again our endeavor. So this is how I would like to position NAFA India Alpha Fund. We do have some companies in the portfolio. The top holdings are there on the screen. This is something that we have bought, and we have about 25 odd names in the portfolio. Some people say it's concentrated, some people say it's diversified. So this is our natural stock picking thing. So we are very comfortable with this number of 25 stocks. The 25 stocks gives me industry diversification. It also gives me stock diversification and everything. So very comfortable with that. Uh, why this fund? I think this is not a mass heavy asset gathering fund. I think one thing which FPS and NAFA are very clear about is that this fund cannot be more than 500 crores in terms of AUM. And this fund is not open to everyone, in the sense that there's only FPS. They are there's a bit of the investment and the fund management is done by NAFA and the selling is done by FPS. So NAFA generally, one thing, of course, Ganesh mentioned a lot about NAFA. One additional thing what I would like to mention about NAFA is we don't have a sales team. We have one person who is in sales. So we are not an asset gathering firm. So we don't have a branch in every city with two, three sales guys in every city who go and kind of attract assets. That is not at all our model. Our model is always word of mouth. Our model is tie-ups like these. So the way I see it, to me, the FPS team we have to give 100% of our focus and bandwidth towards stock selection, towards research. Mind you, why that becomes important is because we are dealing in a space where the research is not as prominent as large caps and mid caps. So today the top 300 names, you will have tremendous amount of research availability that is there. Okay. So it's very easy to find data, find views about these companies. But when you're looking at companies below 500, you need to dwell that much more into primary research, speaking to promoters, visiting plants, doing due diligence, speaking to the value chain, like suppliers, wholesalers, distributors, making plant visits. So this consumes almost 90% of our bandwidth. So we feel that you have certain assets. FPS is the expert as far as asset allocation is concerned. They will do the asset allocation for you, and whatever assets they feel that NIAF deserves, they will give it to us, and we do the management. So it's a very, very simple thing. So we focus on small cap, mid cap, and SME stocks. We have one SME stock. It is only for FPS clients. There is no exit load. Theoretically, you can come today and go tomorrow or day after. There is nothing to prevent you. However, having said that, this product is a long-term product. It can have its ups and downs. In the initial part of presentation, Ganesh mentioned about long-term thinking. This product is a long-term thinking product. On a 4 to 5 year window, you will have one bad year in this product. you will have one very good year in this product and you'll have a couple of average years in this product. So the very good year will take care of the bad year, and we'll be able to capture that upside. So which year will be good, which year will be bad, only time can tell. We are not fortune tellers. So that is how we are approaching. Most importantly, in terms of pricing, this product has a 1% flat fee. Is a fixed flat fee of 1%. There is no variable component, there is no profit sharing, etc. So the 1% flat fee product. So this is I would say a value for money product, keeping in mind your best interests. Uh, and that's how we would like to look at it. Uh, can this be a 5,000 crore fund? The answer is no. Can it be a cute 500 crore fund? The answer is yes, because to the extent of 500 crores, I can still keep buying stocks in this universe that I'm talking about, because we are dealing with illiquid stocks. Let us not, there's no doubt about that beyond the top 100 stocks in India, liquidity is a challenge. If I have to buy even the 110th stock, liquidity is a challenge. So there's a question of impact cost. So beyond that impact, so this is how, like how a sparrow builds its nest. Slowly it takes small twigs and then it builds its nest. Similarly, when I like a stock and you want to build a position, just like how a sparrow is building its nest, you buy slowly. You buy slowly and build your position, and you don't panic, you don't FOMO into any stock, and that's how the portfolio is built. Therefore, there is a hard cap of 500 crores on the upside. So we're not going to be taking more than 500 crores in this particular product. Uh, so if someone were to invest 1 crore, and if this 1 crore were to compound by 15% every year on a 5-year basis, because you are paying only 1% flat fee, you end up saving close to 6.25 lakhs, in terms of fees that you pay to your managers. Because in this particular segment, if you want to find, I personally don't think there's a comparable product, but some close to product, if you want to compare, the fee levels on an industry average is around 2.25%. So we are roughly 40% of the 2.25%. Therefore, your savings on a 5-year basis in terms of fees that you pay to the manager is 6.25 lakhs, if your assets were to remain with us for 5 years, and if it compounds by 15%. So this is exactly what we were mentioning earlier. The industry average total expense ratio is about 1.9%. The lowest mutual fund also is available at 1.4%. The fund alpha fund is given at 1%. So these are the top sectors. So people sometimes ask, do you decide on a sector allocation and then will you buy stocks, or the other way around? The answer is the other way around. This is just an incidental thing. It's not as if I wanted 11% in finance, therefore it is 11. We have chosen stocks. We have 25 stocks. Under that 25 stocks, finance happens to be 11%, insurance happens to be 10%, automobiles happen to be 8%, and so on and so forth. So top 5 sectors is 46% of the portfolio. The top 10 stocks is 45% of the portfolio. Uh, yeah, somebody has asked what is the lock-in period? There is no lock-in period. Like I said, you can come today and exit after 20 days also. There's nothing stopping you. But I would request a mental lock-in of 4 to 5 years. It's only a request. It's not a compulsion, basically. So as per SEBI regulations, the minimum ticket size is 50 lakhs. As per SEBI regulation, BSE 500 is the benchmark that will appear in your portfolio statement, etc. But BSE 500 is not the actual benchmark. The actual benchmark is BSE small cap index. So in an extremely positive market, it will be very, very easy for me to outperform the BSE 500. In an extremely negative market, it will be difficult for me to keep pace with the BSE 500, but that is the nature of the product. Single sector exposure won't cross 55%. and single stock exposure will not cross 25% of the portfolio value. That's about it from my side. I'll open the floor for questions if any, Ganesh. I think I've covered most of it.
Yes, Balaji, thank you so much. That was a pretty insightful session. I think all of you has got a good idea of what we are trying to do. Just a few questions that I personally had. I mean, we keep interacting on a regular basis, and we still are in the know with respect to the fund, but more of to cover on this presentation, right? So you had mentioned about Mr. Trump's tariffs during his first term, right, on steel, basically the tariffs on steel, and how, I mean, incidentally, we were also talking about how similar this recent correction in small caps is very, or should it even be compared to the 2018 correction? I know it was a much different time when balance sheets didn't look as clean as it is today, and it was a totally different period. But would you say it is in a way similar or even comparable to the 2018 period, Balaji? So just maybe a thing on that.
Sure. Thank you for that question, Ganesh. It is somewhat comparable to 2018 on the international side. So there are two things. One is the international side, one is the domestic side. What happened in 2018 is not only the international side. Domestic side, we had huge issues. I will tell you why. 2016, we had demonetization, and 2017 is when GST was implemented. So historically, if you go back and look at any country that has implemented GST, the next 2 years after implementing GST, there is a softness in GDP growth for those countries that have implemented GST, like Australia, Malaysia. So because the GST was implemented, 2018 and 2019 were very soft years from a domestic point of view. Okay, that is point number one. Point number two, our financial sector was in a very bad shape. We had the crisis of Island FS, which went bankrupt. We had DHFL, which went bankrupt. We had Yes Bank, which went bankrupt. There were some lot of scams which came out. Over and above that, we had this tariff issue that was given to us. So fast forward to 2025, what we saw is the magnitude of tariff issue went higher. But by then, the local issues, you had a 7-year implementation of GST, and GST collections are rising by the day. Tax compliance is increasing. Financial sector is as robust as you can think of. Companies have deleveraged their balance sheets, and you have seen that the banks and financial institutions have reduced their gross NPA and net NPA. And today, the same Yes Bank which had a problem in 2018, today you had the Japanese bank which came and took a huge stake in Yes Bank, and it is not just a flash in the pan. You have also seen Emirates NBD come and take a stake in RBL. You have seen Blackstone take a stake in Federal Bank. You have seen, Shriram Finance deal happen with, I forget the name, MUFG or something like that, if I'm not mistaken. So, financial sector is seeing a hell of a lot of deals, from various. Why this happened is because the regulator in 2018 did so many things. It's a classic case when Yes Bank was under a lot of pressure. RBI came in, SEBI came in, private sector banks came in, public sector banks came in. RBI and SEBI came in and told SBI to invest 10,000 crores. And they told HDFC, ICICI, and other banks to also capitalize Yes Bank. And that, over the next half a decade or so, has given an extremely high amount of confidence to the foreign players who are now coming and lapping up these mid-sized private sector banks, because the mid-sized private sector banks have also cleaned up their books. They also have a reasonable CASA presence and so on and so forth. And the valuation gap between the large-sized private sector and the mid-sized private sector was so much to the point where today Karur Vysya, City Union, etc. has beaten HDFC Bank significantly from a return point of view. So history never repeats, it rhymes, they say. So similarly, 2018 tariff, 2025 tariff, 2018 we had internal problems, 2025 we don't have so many internal problems. So to that extent, that is the only difference I would say between 2018 and 2025. But the market correction has been very, very similar. In 2018, what we call as MAG 7 stocks was known as FANG stocks at that point in time. Facebook, Apple, Alphabet, Netflix, whatever. Uh, Facebook, Apple, Amazon, Netflix, Google, FANG stocks. Now it's called as Max 7 stocks. So India also there was something called Rithik stocks, which are coined HDFC, Reliance, Infosys, TCS, because these were the 7 stocks that were performing, and rest of the market was not performing. Because these 7 stocks had such a high weight in the index, it seemed as if the index is at a close to all-time high. And magazines and papers used to say the index touches all-time high, this level, that level, and then people open the portfolio is bleeding, 15% down, 20% down. We had a tough time educating investors in that cycle that look, uh, this is not what you see. The different segment that we operate in that has fallen, so you have to see it this way. So those investors who bore the brunt of that cycle were heavily rewarded in the next cycle, 2021, 22, 23, 24, etc. So in 25 again we are seeing that same cycle playing out. So I think if these people are able to grit their teeth and hold on, then you are going to see much better times in this particular category, is in my humble opinion.
Got it, Balaji. So, like you said, it's pretty similar and also in its own way, the situations in 2018 and in 2025-26. With that being said, right, it is usually said in the market that when periods of corrections like this, right, what happens is you tend to shake out the weaker sections or other weaker beings in the market so that you are left with quality players standing there for, right? So, today, I just want you to take your attention back to one of the slides that we had discussed, the median market cap of NIA, right? It's around 7,000 crores. So when you had mentioned that, you had also mentioned that the typical market thinking is that, let's say you go below 7,000 crores, there's a lot of or there's a lot of thinking that, okay, I'm choosing a Kachra company over a quality company. But how does NAFA exactly, as an investment team, try to dissect between a Kachra and a high quality company? Just coming from the perspective of being, let's say you made your mistake in 2018, right? You don't want to make the same mistake in 2025. So you try to avoid the weaker ones and then try to stay with the strong ones, despite the fact that corrections were homogeneous across all the sections. So if you could maybe throw a little bit of light on how you identify quality in this space.
So essentially what we do at NAFA is to do a couple of things. One, we generally are on the lookout for sectors and companies that can grow at 1.5 to 2 times the nominal GDP. So if you are able to identify those sectors, that is point number one. Point number two, we need to have solid reasons as to why these sectors and companies are growing at 1.5 to 2 times the nominal GDP. So essentially, we have boiled that down to two reasons as to why that can happen. One is a commodity reason where there is a demand which has exceeded supply, so there is volume growth and value growth, and therefore, this particular commodity, depending upon their cycle, can keep this pace of exceeding the GDP growth for the next 2 years, 3 years, 4 years, etc. That is one way of looking at it. Second thing is a much more structural reason where the players in the market, the people who consume products and services, they have changed their habits, they have changed their lifestyle, and the way in which they consume their products and services to the extent where they give up on certain habits and develop new habits. So when that happens, the habits that you give up on, they those get reflected in certain industries, which start falling back and they start degrowing at less than the GDP growth rate, and the new habits that they cultivate start growing greater than 1.5 times GDP. I'll elucidate this with a couple of examples. In 2008, 3 out of 4 cars sold in India was a hatchback car, meaning it was a small car. The automobile, buying in India was always value based. People used to go to the showroom and they used to compare mileage. Mileage was a very, very a big thing, because fuel cost as a percentage of expenditure used to be a very significant portion way back in 2008. So you want a car that can give you more mileage for the buck. So that's how a car was being bought. Safety, in fact, became secondary at that point in time. Today in 2025, the same 3 out of 4 cars, it has become SUV, crossover, and mini SUV. So from value-based buying, you have moved to feature-based buying. People are buying cars with sunroof. People are buying cars with 6, 7, 8 airbags. People are buying only automatic transmission, which is known to give much far lesser mileage than a manual transmission. Uh, and feature-laden cars is what they are going at. So it's a classic habit change that has happened. So you can have a situation where if I'm an automobile industry, I can go at 10%, for example. Within that automobile, if I'm manufacturing only hatchback, I can grow at X minus 200, 300 basis points because the customer has moved on and I have only hatchback. But if I'm an automobile company, I make SUVs and mini SUVs, I'm very strong in that. I can grow 10 plus 3, 4%. So I can outperform the industry by virtue of being present in that segment which the market is liking at that point in time. So either you play that particular segment or you play the first derivative or second derivative of that particular segment. So you don't need to buy the OEM, you can buy the ancillary player, or you can buy the ancillary player who is supplying to the ancillary player. So that's a second derivative. Similarly, we have seen this in furniture also, where people used to call carpenter at home and give them the work order and get their furniture made. But today, people are, hard pressed for time. So they go to a, showroom to buy their furniture. And therefore, a lot of MDF is being used this day and age rather than plywood. So MDF is growing at 1.5 times GDP. Plywood is growing at 0.5 times GDP. So plywood furniture, if you recollect your grandfather's furniture, it used to be very heavy, bulky. It cannot be carried so easily. It will be passed on generation after generation. It will last 30, 40, 50 years. But today's furniture is made as light, sleek, durable, and can be replaced in 5 to 10 years. Because a young couple moves from, say, Coimbatore to Bangalore, or they move from a 2 BHK to 3 BHK. So they change the theme of the house. So they have some time during weekends. They go and buy ready-made furniture. We are seeing this happen in the dairy segment because I'm sure it's a South Indian audience in this webinar. They can relate to what I'm saying, that, our grandmothers used to always make the value-added dairy at home. Only the milk was bought from the milkman, and value-added portion, that is curd, paneer, cheese, ghee, butter, everything was made at home. But now, whether it is Wistron, Pegatron, Tata Electronics, all these factories, they're all hiring women. Women participation in the labor force, South is one of the highest. TN especially is very high. So there's paucity of time. And therefore, people are okay buying a ready-made value-added product from the store. You pick up a tub of curd, or, you buy a slice of paneer. So, uh, these have more linearity in margin. So if I'm a dairy company, if I just sell milk, I'm only indulged in commodity. I don't have pricing power. I'm not a price maker. I'm only a price taker. But if I convert that same milk into value-added products, then I have a little more pricing power and there's a little more linearity in margins. And this is because of change in the habits of these consumers. There is also increased demand to people to look at adding more protein into their daily meals. So all these things indirectly, it helps the dairy industry. And that's how we generally look at companies and ideas. So all these companies can be found below 7,000 crores, below 10,000 crores. It's not necessary. In fact, over the top, 1 lakh crores and above, I don't find these kind of companies, Ganesh. That is the problem today. So today you are having large caps that are growing outside in the listed universe. Apple India, by virtue of selling 1 crore phones, today is a 75,000 crore turnover company. But I can't buy Apple in India. I can buy Apple global stock, but I'm getting a global exposure. YouTube India has a turnover of 18,000 crores, but I can't buy YouTube in India. I can buy Alphabet where I'll get the global turnover. So people say that large caps are not growing in India. Large caps are actually growing. It's just that the large caps that are growing are not listed. Okay, so TCS has a problem, but Amazon is growing. Amazon in India is growing at 15-20%. Apple is growing at 14%. The technology, these companies are growing, but they're not listed. But the growing companies, am I able to find below the 500 stock? The answer is yes, because of these changing themes. So we are present in that segment.
Got it, Balaji. Another question on the GDP part that you mentioned, right? The nominal GDP being very close to the overall index's performance over the long term, if you stretch back and look at it from that perspective. Now, we are typically running in an environment where the government is pivoting more towards this 9 to 10%. I mean, we may be conservative for, I mean, we might turn out to be a good, it might turn out to be a good decision in the overall global turbulence today to be a little bit conservative. But you think when just to connect this with FII flows also, if FIIs don't find our numbers to be, let's say, between 10 to 12%, would it be really worthwhile for an FII to come and invest in India today? And considering that FIIs don't directly come into small caps, right? They first take positions in large caps and then eventually it trickles down to small and mid. So how do you see this overall thing, Balaji, on the macro front?
See, it will. The thing is that FIs also have meaningful ownership in mid caps. I mean, of course, they have bulk of the ownership in stocks like HDFC Bank, etc., which are large caps. But FIs also have some meaningful ownership in mid caps, and from a double-digit nominal GDP growth, we have now come down to a single-digit nominal GDP growth. Why NAFA and Alpha Fund is that much more important is because that historically, when large caps have mimicked the nominal GDP growth, so far the nominal GDP growth has been 11%, Nifty 50 has given 11 to 12%. Now the nominal GDP growth is around 8-9%. Nifty 50 are the chances of Nifty 50 mimicking nominal GDP growth at single digits? The answer is yes. So for you to make meaningful double-digit returns, you are in a way kind of forced to look beyond the large cap companies in India. So our view is that very simple. We can't really time what the FI will do or when he or she will invest money, etc. So who would have thought that a bank like RBL will find love from Emirates NBD, or a Blackstone will look at a South Indian or a Federal? And these were all like obscure names. When
Right.
HDFC Bank used to trade at 3 times price to book, these banks used to trade at 0.8, 0.9 times price to book. Like I said earlier, if there is a respect to the valuations, irrespective of who it is, I think somebody will come and reprice these stocks upwards. So we are also seeing a huge explosion of the fund management industry in India as well, various styles, various kind of fund managers. And for all that growth, there are meaningfully only about 350 managers in this country, if you include PMS managers and mutual fund managers. Whereas this is for a 1.4 billion population. Whereas if you look at a country like US with one third of our population, 330 million, there is almost 3,000 fund managers there. And Europe will also have similar 3,000 fund managers, long only, long short, hedge
Mhm.
funds, so many things. Uh, so, uh, so our job is to just make sure that we are extremely value focused, and like in the initial part of FPS thing, you had mentioned about the risk element, which I strongly concur with. That if you want high returns, you need to take high risk. That's the most absurd thing that one can actually think of, right? So if you want strong returns, first of all, the risk should be extremely low. Only when the
Right.
risk is low, the returns actually become very, very strong.
Right.
So in this environment, to kind of build a portfolio beyond the top 500 stocks, cognizant of risk, is something that we love to do, and we see that as a challenge, and we would like to do that.
Got it, Balaji. So what I'm understanding is that you're saying it's more important to be bottom up today than it was ever in the past, right? So you can't just look at headline numbers or just blindly go towards the index, because that itself is a little bit. I mean, since if we are going to operate in this scenario between 9 to 10, I think it makes it more worthwhile to be a lot more bottom up than usual, right? That is what I think you're coming to, right?
Very clear, because your mutual fund AUM is 85 lakh crores today,
Right.
and your overall deposit, systemic deposits, is probably 200 lakh crores, if I'm not mistaken. So we are about 35% of deposits. If you look at US mutual fund AUM will be 3 times the bank deposits, basically. So the depth will increase in the listed universe without a shadow of doubt. And secondly, you will see that people will realize that if automobiles is growing, you can see the daily or monthly data that comes in automobiles. I'm very clearly seeing that Toyota is growing faster, Kia is growing faster, MG is growing faster, BYD for its small base is growing faster. But I cannot play these names even if I want to. Okay, so I'm stuck with M&M, Tata Motors, Maruti, and Hyundai. Out of that four, maybe one will grow. M&M is
Right.
currently growing fast. So out of four large caps in auto, only one is growing. Out of four large caps in two-wheelers, that is Bajaj, Hero, TVS, and Eicher, only TVS is growing. To some extent, Eicher is growing. So this is a problem that is prevalent across a lot of large caps. So which is why it's imperative to be beyond that, in our humble opinion.
Understood. Thank you, Balaji. I think that was a pretty insightful session in the Q&A. I think we can move the floor to the audience as well if they have. If you have any questions, could you please type them out on the chat box? I think we have one question that you had already answered from Mr. Ashok. What is the lock-in period like Balaji had mentioned? There's no exit law, there's no lock-in, but at least from a thinking perspective, you can keep in mind that you have to come with at least a 4 to 5 year time horizon so that you entirely get the benefit of this product intends to do for you. And a question from Mr. Ravi, can we invest in tranches? So I would like to take this question as well, Balaji. So that, as per the SEBI regulations, the requirement for a PMS to start even is 50 lakhs, the minimum requirement. So it would not be able to, so you can transfer in tranches after you open the account, but we will be able to start investing for you only after we completely receive the entire 50 lakhs in corpus. Hope that answers your question, Mr. Ravi. And there's another question from Mr. Ashok. What are the other sectors other than automobile? Do you think there are niche IT, electronics, product assembly, and AI, construction, medium scale manufacturers may grow due to government infrastructure investments? If you could take that, Balaji.
So yeah, I mean there are a lot of these niche companies that are there. So construction equipments, construction manufacturing, we do have companies like InterArc. For all the new plants that have to be set up, the pre-engineered fabrication business can grow at a very very fast pace. That is how we are playing this particular sector. We also feel that the niche consumer segment can throw a lot of opportunities because of this changing consumer behavior. Niche IT, electronic product assembly, and AI, nothing really specific, at least as of now in my portfolio, but we are always on the lookout for such names, basically. So yeah, I mean, we would like to believe that whatever we have now, there is a niche element in that rather than anything that is very generic. And it's more like a forward-looking portfolio where over the next 3 years, they have the tailwinds because of they are currently in the process of building capacity. Therefore, the depreciation is very high. Therefore, the P&L is suppressed. But once the capacity comes on stream, the cash flow start kicking in, the operating leverage starts kicking in. Then you will see earnings growth. So these are the type of companies that we have. So we have positioned the portfolio. One thing is we have positioned the portfolio in such a way that we are not stuck with yesterday's winners. So there are many names in the solar side, in the all these things. There is a significant up move that we have already seen. So we're not present in those particular segments. We are present in those segments where there's been a fair bit of underperformance already. They are in work in progress mode, and you can very soon see these companies scaling up. That's how we have kind of built the portfolio. How would you handle redemptions given the low liquidity? That's another question by Mr. Karthik. So I think uh, we have not seen a situation where we invest in stocks where the liquidity is that low that it's going to become an extremely challenging thing to redeem. And we also don't believe that we will see more than 5% of our assets getting redeemed on a single day. So for example, if NIAF is a 100 crore fund, we don't see more than maximum of 5 crores getting redeemed immediately. So that those type of redemptions we can still handle. uh, so what we generally do is both via buying and selling. We don't participate more than 20% of the daily average traded volume. So if a stock were to trade 50,000 shares in a day, we will not buy more than 10,000 shares. Similarly, if the stock were to trade 50,000 shares in a day, we will not sell more than 10,000 shares. So when we do that exercise, we are able to redeem or invest quite easily in these markets. So that's not a huge challenge basically. Mr. Jawahar has asked how frequent is the churn or average holding period of the scripts or dividends in the hands of investor. A churn is around, I would say, around 20% in a year, if I have to like literally put a number to it. So it's not a very high churn portfolio or a momentum driven portfolio where you're trying to play the next quarter earnings and therefore you sell the previous holdings and then you buy the fresh holdings. So we don't do any of those type of jugglery. So there are 25 stocks in the portfolio. I think there'll be 4 stocks that will get out and 4 new stocks might come out. This is in a year I'm talking about. That's the kind of churn that we are looking at as far as the portfolio is concerned, basically.
I think
Dividends, are they in the
yeah,
hands of investor?
please. Yeah, that's what I was getting to. So,
So what is on that, Ganesh?
No, no. I was just going to answer that. So I was just saying, see, on the dividends part, right, or on any capital gains or dividends, it would be taxed straight in the hands of the investor only, because this is typically more of a arrangement between ANAFA and the ultimate client, where we get the power of attorney to execute transactions on the client's behalf. Right. So what typically happens is it's pretty much like you handling your own portfolio while giving us the username and password for it, to make it very, very simpler terms, right? So with respect to any capital gains or with respect to any dividends, right, that will be in the hands of the investor if we are talking about taxation. With respect to dividends, whether it will be redistributed to the investor, the idea is to redistribute it, or other idea is to keep it or plow it back into the investment itself, and that will in turn be a part of your overall corpus in terms of how it is being deployed. So it's not exactly redistributed, is what I'm trying to say. Correct me if I'm wrong, Balaji.
Yeah, that's right.
Yeah. I think that was the question. So if any other questions are there, could you, if you have any other questions, you can type them out in the chat box. We'll be happy to answer them. I'll just give a minute, Balaji, then we can see if there are no questions, then we'll go to the conclusion of the session. Yeah. Okay, I think there are no further questions. Maybe I'll just conclude the meeting so that we can move it. Thank you so much, Balaji, for accepting our invite and presenting. I think, okay, we have one person who's typing. Let's see if he has any questions, then we can move forward. Mr. Arvind is typing out his question. Okay, I think he was thanking us for the session. Okay, thank you, Arvind. Thank you, everyone. Thank you, everyone, for joining us. Thank you, Balaji, for joining us on the session hosted by FPS Assets. Like I had initially mentioned, right, FPS Assets and what Balaji also had clearly mentioned is that we will be taking care of your entire wealth portfolio, while NAFA, again, why we partnered with them is also something that we would like to reiterate. These kind of questions, right, or these kind of interaction is what we have with NAFA on a very regular basis. So we'll be completely in line with, or rather in the money with respect to whatever portfolio is, wherever your portfolio goes, whether it's going to be through PMS, where we have an exclusive distribution arrangement with NAFA or any other product that we bring to you with respect to your portfolio will be completely in sync with what was going on with your wealth creation journey. So thank you. Thank you all for joining us. Thank you, Balaji. And we'll meet on
Thank
another
you.
session in the
Thank you
future.
everyone for taking the time out on Saturday. Thank you, Ganesh, and the FPS team. Thank you. See you again soon.
Thank you. Thank you, everyone. Thank you.